The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers from Akers Financial Group. I'm a certified financial planner practitioner, and we welcome you to Winning in Retirement. Today I have Jeff Akers from Akers Financial Group, who's a certified financial planner practitioner, here with me also. Good morning, Jeff.
Good morning, Brian. Good to see you.
You doing okay?
I'm doing great.
I sure hope so, because we got a 1 hour of an intense, informative show that we got to bring today.
Education. It's time for some education.
Is that your middle name?
No, not my middle name.
Yeah, absolutely not. But it is your job. It is what we do. Educate, and then you implement what they need to do. The key thing to our show today is this. We want you to think about this. Never pay taxes again. Is it possible to never pay taxes again? If you use some of your money to pay taxes now, you won't have to pay again. That's huge. And this show is huge for your future. I get all excited about this show being huge.
When you're talking about never paying taxes again, that is exciting because I love not paying taxes. That's fantastic.
Well, the idea here is this. On some of our money, we can create ways to never pay tax again. Other pieces of our money, we can't avoid the taxation. It's coming.
Right. But I really look forward to figuring out how to lower or minimize those taxes in the future.
All right. So we got to tell everyone what that really means. So never pay taxes again. Huge question mark. What's the lead topic on that, Jeff? Go ahead and rip off the curtain.
Okay, I'll give it away. We're going to talk about Roth IRAs today. Roth IRAs, it's a way to not pay taxes in the future.
Never pay tax again is the Roth IRA. That's what a Roth IRA does, and that's what we're going to try to explain. We're going to give you a lot of uses, what you should do, what you should think about, and why it should be part of your financial plan, no matter what income and net worth you may be.
That's right. Having a Roth IRA, it provides that way to have some money for retirement that when you look at your account and it says, here's how much money you have in your account, you can think to yourself, if I take money out of that account, that's how much money I will get. With a lot of other accounts, you look at it and you say, well, if I take money out of that account, I've got to subtract taxes, and the amount that I actually get is going to be less than what I see on that statement. So the Roth IRA is a way to look at an account and know that's my money.
All right, the fundamentals of a Roth IRA is Roth, R-O-T-H. Roth is named after a senator from Delaware.
Yes.
It was Big Al Roth?
I don't remember his first name.
I think it was Al Roth. I don't know if he's big or not. I just added that for flavor. But Al Roth, back in 1998, was the first year of the Roth. Back then, they did Roth conversions. You spread the tax over 4 years. There's a bunch of things going on. But that was one of the last times that the federal government had a balanced budget.
Yeah. The balanced budget, well, I like to say it was because of the Roth IRA and all those conversions going on.
Right, but who was the president?
That was Bill Clinton.
And who was the Congress? Who's the head of that?
That was Newt Gingrich at that point.
Right, and so they compromised and came up with...
Compromise? What the heck is that?
It was like, well, what just happened in America? 2 years in a row, they actually balanced the budget for 2 years in a row, and that's an incredible thing.
Yep.
Didn't happen before that much, and didn't happen at all after.
Hasn't happened since.
It's a big deal on why a Roth is even more important now than when it first started. But the concept in 1998 was this: hey, we can get people to pay tax now and never again if they convert their retirement money into a tax-free Roth for their future. They don't have the federal government got more money in their coffers right away.
They got money now instead of having to wait until later to get money and taxes from it.
All right, so Roth IRA, people are driving their car, driving their lawnmower, listening to this show, and they're thinking, all right, Roth IRA, the basics of it is the money goes in. There are limits to how much you can put in. It's usually limited on contributions based on what you earned.
Right, so you have to earn at least what you're putting into it, and if you're below age 50, that number is $6,000. So hopefully everybody's earning more than $6,000, and you can put $6,000 into a Roth IRA.
Well, let's say you make $2,000. Let's say you make $2,000. You're retired. You can put $2,000 in your Roth IRA.
Yes, you can, and there's no age limit to that. You can put that money in. Mm-hmm. It's wonderful.
So what happens on a Roth IRA is a contribution is where you can put the money in any year. That year, like for 2022, you can do it from January 1st until April 15th of 2023. That's how long you have to put money into a Roth IRA.
Right. Now, at the upper end, there is an income cap where if you earn more than a certain amount of income, your ability to contribute to a Roth begins to phase out and eventually goes to zero. Right now, it's over $200,000 for a married couple. It's around almost $130,000 for an individual, a single person.
So that means married filing jointly, if you make more than $204,000, it'll phase out over between $204 and $214, I think.
Yeah, I think it is $214, $10,000 spread there.
And so the idea is this: we have money, and that money might be sitting in our bank account, might be sitting in our brokerage account, money that's taxable each and every year. If we have the ability to shift some of that money over to a Roth, why not?
Yeah, why not?
I want you to think about it. No matter what age, if you have earned income is from working, from a job. It's not from investments. It's not from retirement. It's from a job. It's on working your business. It's getting a W-2, 1099, things like that.
Right. So you've got earned income and you say, well, I don't need this income right now. I might need it years down the road. Well, why not put it into something so it'll be tax-free years down the road and hopefully more than what you put into it?
Right. So contributions can be done on an individual Roth IRA, which you can get one of those by giving Acres Financial Group a call. We can talk to you about way it works and how to get one started. The second thing you can have a Roth IRA, and you can have a Roth 401k or a Roth retirement plan where you work.
Right. Some Roth or some retirement plans have the Roth option. So you can put money in. You don't get the tax break, when it comes out of your paycheck, because it's going to be tax-free in the future for you. Now, keep in mind, if you're doing a 401k or any kind of retirement plan where you've got a match, so you're putting money in and then your employer is putting money in too, the money you put in can go to the Roth side, but the money that's being matched, the contribution from the employer, that will always be on the traditional side. So on the traditional side, that means that you don't pay tax on it now, but it's deferred. You will pay tax on it in the future.
Who should consider doing a Roth?
Everyone should consider doing a Roth.
Absolutely. That's exactly the point of this show. Never pay tax again, and then you need to consider how a Roth fits in your plan. That's what you got to do. That's the only note you write down today is, how do I fit this in my plan? Call Acres Financial Group. That's it. Write it down.
Yeah, that's it. Well, I guess we're done.
Show's over. No.
Show's over.
So the idea here is we're going to try to explain different reasons, situations, how it works, how we apply it, and the understanding around why it's so important this year, 2022, understanding what is so important about doing it. So we're talking about contributions. The other way of getting money into a Roth IRA is called a conversion. What is that?
Okay, so a conversion, let's say you have a traditional IRA, maybe you've contributed to it over the years, maybe you had a prior job that you rolled over into an IRA. An IRA is tax deferred. That means you didn't pay tax on it up front, you're going to pay tax on it later when you take money out. Well, we can take money from that IRA, convert it into a Roth IRA, pay the tax right now on the amount that we're converting. We talked about that earlier. It's how they balanced the budget back in the late 90s. Convert that, pay the tax now, but now it's in a Roth IRA that we never pay tax on again.
All right, so conversion.
That's a conversion.
All right, so logistically, how does someone do it?
Well, logistically, you're going to have to open the Roth IRA, and you're usually going to have to sign a form that's a conversion form that says what to convert. So you might have stock, and maybe that stock has gone down some in value, but you think, oh, it's going to come back up. Well, go ahead and convert it while it's at a lower value, because that means you can convert more shares of it, pay tax on that lower value, and then have it grow tax-free down the road. So you get to pick and choose what you're converting. It's usually done by a form, though.
Right. So the actual moving the money from a regular traditional IRA to a Roth IRA has a Roth conversion form, and it happens on a certain date. On that date, whatever quarter that falls in, that's typically when you owe your taxes. And we recommend that you consider paying a quarterly estimate out of your cash account on the conversion for the taxes during the quarter that you actually did the conversion.
Right. We'll take a look at your taxes from the prior year. We'll talk to you about what your income is looking like this year, if there's any big changes, and we can tell you how much to pay in that quarterly estimated tax.
And then that gets more complex, and that's why a financial planning advisor that's sitting there calculating for you, going over the issue, and basically helping you understand what's going on so that you are in good shape for the future when it comes to putting your money into the Roth, so you can get the money into there to where it can grow tax-free. There are many reasons considered this year, but the first concept I want you to understand is you want to pay tax now and never again. The Roth IRA, it has the money goes in after tax, and then it grows tax-free. Interest, dividends, capital gains, when you pull it out, all tax-free. It's also tax-free for your beneficiaries, right, Jeff?
That's right. So if you pass away and you might leave it to your spouse, and they can make it their Roth IRA. We'll talk a little bit more about that later. Or if it's not a spouse, then they can receive it as an inherited Roth IRA. They'll have 10 years to take the money out, but when they take it out, it will be tax-free going to them. So among all the things that you can leave to your heirs, your beneficiaries, the Roth IRA is one of the best that we can leave to them.
Absolutely. So what we covered here in the first quarter is this. Never pay taxes again. How you do it, understand the uses of a Roth IRA. You can contribute to one, or you can convert money into a Roth IRA. Those are all things that you need to put on this list of things you should do and consider right now. Don't put this off. The reason we want to do it right now is the fact that markets are volatile. When markets are down, it's a great time to consider doing Roth conversions. Tax rates for this year are at the lowest we think they're going to be, and very important to do that. Now, what we want you to do is, of course, give us a call at Acres Financial Group. Acres Financial Group, we're local, we're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville and Forest Hill and clients all around the state and even all around the country. It's so easy to begin winning in retirement. You can just give us a call for a free consultation with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you back on Monday to schedule a free in-person or Zoom meeting. Go to Acres Financial Group. When you go to that website, you can scroll down and put in the. You can set a meeting through the website right there, or you can just go and give us a call at 833-946-7384 to start planning for your retirement now. Why pay taxes now? We will explain in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I am Brian Akers. Here with me today is Jeff Akers. Jeff Akers has been working along with me for over 22 years as financial services, and he has been working with a number of our clients over these years, bringing his unusual set of skills to the table. Financial advice, the information. He also has the degree in family and marriage counseling, which the combo is just something that's unusual but works very well for Jeff. Is that a good intro, Jeff?
Yeah, that works.
That works. How do you feel about that?
Yeah, one thing to keep in mind, yes, I've been at this for a little over 22 years, and Brian's been at it for at least 10 years more than that. So Brian's been at this a really long time. So he knows what he's doing. He's taught me well. And the marriage and family counseling does come in handy because people have discussions about money all the time. And so we get that straightened out, and then they're happier.
Yeah, but we do thank you for listening to Winning in Retirement, because we all want to win in retirement. No matter what age you are listening, if you're thinking about that future and dreaming about that day. We, of course, want you to have a good balance today and the future, but we want to make sure that you make your money last a lifetime. And one of the biggest things you need to understand is this: how to never pay taxes again. And that's why we put this show together. How about never pay tax again on some of that money? If you never pay tax again, that's a lot easier to keep up with inflation and cost of living that's going on out there, is when taxes are not part of your budget. That's a great place to be. So today's show is about Roth, but we're trying to cover in the second quarter here is why pay taxes now. And the first concept is this: in 4 years, there's going to be a sunset of the current tax brackets, thus raising all of our tax brackets up. we have 4 years. In January of 2026, that year, your tax brackets will go up. Are you ready for it? Have you ever heard of this? Well, it's coming. So, Jeff, explain that a little bit more.
So the most recent tax law that was passed was at the end of 2017, took effect in 2018, and it's set to expire at the end of 2025. So January 1st, 2026, the tax rates and the tax code is going to revert to what it was in 2017. That means that the tax brackets, those numbers, are going to go up, and it's going to be varying amounts along the way. The top tax bracket goes from 37 to 39.6%. Other brackets along the way, they go up anywhere from 3 or 4% each. So every bracket is stepping up, and that means no matter what bracket you're in, you'll be paying more in taxes.
And then there's some other interesting brackets. So a tax bracket goes like this. If you make very little money, if you're married filing jointly and make less than $20,000, and it shows up as taxable income, you pay at a 10% bracket, and that's like a step. After $20,550, the next step this year, it goes up to a 12% taxes. And then that's a pretty good rate, and that lasts all the way to $83,550 for taxable income, and that is for married filing jointly. Now, the next bracket above is 22%. Yes, 10% higher if you go over. Now, that's only on money on that next step up, not for the first $83,550. Then there's a bracket for $24,000, and once you're above $340,000, you get the 32% bracket. Once you get above basically $431,000, you get into the 35% bracket, and then ultimately 37% is the highest. The interesting thing is this: is if you married filing jointly and you make less than $340,000 or right near there, in the 22 law, you pay 24%. If you look over in the 17 law, you pay 33%. And that's because that's money that's coming. Yeah. Now, there are some good things that people would say is that, well, in the 2017 law, most of us itemized. We had personal exemptions of $4,100 back then per person, or $4,050 per person, I think. And then what happens that you did itemization instead of standard deduction, and that allowed you to take your taxes. It didn't have a SALT limitation, state and local income tax. And so some people complain about that SALT. The problem is that when you change that bracket,
it makes up for it.
You end up owing more tax. I'm all about the bottom line, and the tax law change, the Tax Cut and Jobs Act of 2017, it changed most people, like in the 99 percentile, in 95 to 99%, basically did better at their taxes. Right,
and when he says gets better with your taxes, if you paid $20,000 before in federal tax, then the next year maybe you paid $18,000 or $19,000. So you paid less in tax, regardless of deductions, regardless of brackets or anything like that. It was just less money out of your pocket going into the government.
Yeah, so the concept for the second quarter is this: pay tax now and never again. We believe that there's a 4 years till it sunsets to the old rates, and we need to consider paying some tax. The reason I want to say right now is I can't tell you that tax rates won't get brought up earlier. There's many reasons that taxes could go up. What are some reasons that the federal government could raise taxes, Jeff?
Well, people might have heard that we've got a lot of debt, national debt, and so we need money to pay that debt. When I say we, the government needs money to pay that debt and to pay the interest on that debt. Mm-hmm. And so the more money that we owe, that also means the more money that we're paying in interest to service that debt. So as that need goes up, they're going to be looking for ways to get more in tax revenue to cover it.
If you want something interesting to do, you can actually go on the internet there and go to usdebtclock.org. That's on the website, and also has its own app now. And you can actually follow debt of the federal government in many different ways. And you also follow debt of the state that you live in.
Wow, that sounds depressing. But
well, it's a clock that's rolling. I mean, the numbers are clicking very fast, almost as fast as the gas pump.
Oh, man, that's fast.
That's true. Now, one of the things about taxes going up, what happens is this: the revenues or the budget that's coming out, such as the federal government, how much of it actually goes towards debt and entitlements and things like that. That's going to increase higher and higher. One of the things to look at is gross domestic product, like what we actually produce. Right now, it's about actually in the 20% of what we produce as a country is paid out just in interest and entitlements, Social Security, Medicare, things like that, out of the budget. In just a few more years, by 2030, we're going to be paying almost the entire budget out in interest and entitlements based on the current projections of Medicare, Medicaid, and with interest rates rising, what it's going to cost on the national debt side. So there's a idea that if you don't have a budget for anything else, you must raise taxes. So the concept here is we know taxes are sunsetting, going up. We think they might go even further than that. And that's why you have to consider pay tax now, never again, so that you're not having all your money taxed at a lot higher rate in the future.
All right, so put yourself in a better position for the future down the road.
Absolutely. Now, is it wrong to try to avoid taxes, Jeff?
No. There is an interesting quote from 1934. Now, if you think of 1934, that was in the midst of the Great Depression, and there was a judge with an awesome name. His name was Learned Hand.
Judge
Learned Hand. And he said, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in arranging affairs as to keep taxes as low as possible. So here's a judge that said, keep your taxes as low as possible. It's the right thing to do.
And it's a quote.
It's a quote.
So it's got to be real.
It was part of a case. So This one really is real, even if we saw it on the internet.
Absolutely. So what's going on here is this. We're talking about taxes going up. And the thing is, as well, if taxes are at a discount right now, why not pay them? Now, typically, if you go see accountants and you're talking to them, you're trying everything you can do to pay the least amount of tax right now. But what if the answer really is the opposite? Let's pay tax now and never again. The opposite of taking extra deductions and paying the lowest tax, let's pay more. What if we just consider filling up your current bracket that you're in? So if you're in a 12% bracket, 24, 32, whatever bracket you might be in, how about filling that all the way up? We had some cases that were at the high bracket now, which is 37, and we were looking at Roth conversions, and we did some extremely large Roth conversions because we thought, well, if we pay tax now, the answer is we'll never pay tax. And we can let that money roll and grow to the future, which can be a very good thing. That is called a Roth conversion. The converting of your qualified money to a Roth IRA, which then you pay tax now and never again. Extremely important idea to think about.
Yes, it is. Now, as you were mentioning, the idea of sometimes we'll go to accountants and we want to reduce our taxes right now and we're going to pay them later. And usually the argument for that is in retirement, your income will be lower, you'll be in a lower tax bracket. Well, what we'll tell you is if you're in a lower tax bracket, it's because your income is lower and therefore your standard of living is also lower. Most people don't want to get to retirement and then have a lower standard of living than what they have now. So Brian talked about filling up the tax bracket you're in, and we talked before about the sunset provision coming up in 2026. So if you pay tax now and you pay 24% and fill up that bracket, then in the future, that number is going to be 24 is going to go to 32%, isn't it?
It's a combination of 25, 28, and 33.
Right.
It really depends on exactly how much money you make.
Yeah, so you're paying less tax by paying it now than if you waited to the future. Even if your income went down, your bracket, this sounds weird, your bracket could go up, but the actual percentage you're paying could go down.
Now, you might be in a certain situation that in 2022 might be your retirement year. It might be the year where you get paid out of a lump sum of sick leave and some other large checks as you retire. And it might not be the best year because of a high tax year. And so you might have to wait until that first year of retirement to start doing some Roth conversions. A lot of times in your 60s, we do a lot of Roth conversions after somebody retires and before they draw Social Security. Because we have low income, we can take some income at a very low bracket and save it for later. We live off cash for a while. That's why it's so important in retirement planning is to diversify in where you save so you have lots of choices in your retirement. The younger you are, you really must consider Roth contributions. And as we get older, we ought to convert the plans we have. Younger people, as you think about changing jobs, why not convert that 401k that you are just pulled out? It's not a bad idea to get that growth in the market. Now, the whole goal here is this. We want you to win in retirement. Winning is where the best part of retirement is getting your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away when you retire. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at acresfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's acresfinancialgroup.com. Or you can give us a call at 833-WIN-RETIRE. That's 833-WINRETIRE. We will call you back on Monday to schedule a free in-person or Zoom meeting. Go to acresfinancialgroup.com or give us a call at 833-946-7384 to start planning for your retirement now. If you're married or single, it makes a difference. We will explain in the second half.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to the second half of Winning in Retirement. I'm Brian Akers, and here with me today is Jeff Akers. We're both certified financial planner practitioners from Akers Financial Group. That's right here in Maryland where we work with people, and also we work with clients all around the United States. Now, Jeff, you're ready to go here in the second half?
Oh, yeah. Halftime's over. It's time to get this done.
Yeah, I felt like I was the coach this halftime, trying to pump you up for the second half.
Well, that's kind of in your nature. You just have to be the coach.
And we did the playbook. We got our plays ready to roll.
Yeah, ready to roll the second half.
Hey, you ever thought about if you were going to watch a game, what's really going on at halftime? Like in the locker room, are they fooling around? Are they getting serious? What's going on?
It's always a little disappointing when you hear the microphone in the coach's huddle. You're like, oh, I think they're saying something really big. And no, you listen to what they're saying. It's like, what? I could have told them that.
Well, the best thing to do is to get players to relax, understand what the goal is, and get back together. And that's exactly what a good financial show should do is this. You're thinking about your future. We don't want to worry about that future. Let's do things right today so that we are in better shape in the future. Imagine you pay your tax now, and in that future, you never pay tax again. Does that sound pretty good?
That sounds really good.
And that's exactly what the show is about today. It's never pay tax again. Yes, it's a show about Roth IRA, on why you should do them, why you should think about doing them now, and even right now are all very important things. So we talked about Roth contributions, we talked about the tax law and why it's important to convert now. Here in the third quarter, we want to talk about situations that the Roth conversion is just perfect and perfect timing. One of them is this married versus single. Like I want to say signal all the time, but married versus single. And the key thing is this, is married tax rates are better than if someone passes away, that the year after you become a widow or a widower, you then are at a single tax rate, which are a lot worse if your income stays the same.
Yeah, if your income stays the same, you will go up a bracket or two, and then you'll end up paying more taxes when you have to take money out of that IRA.
Absolutely. I guess one of the things that we want to explain is suddenly single. So a person passes away, your spouse passes away. That calendar year, you get to file jointly that year.
Right.
And that's your last year, you can file jointly. Jointly rates, an example would be if you make around 105, 106,000, or 108 actually, up to 108, you take your standard deduction, and then you end up being in the top of the 12% bracket at around 83,000. Now, that same kind of income, so if the person that's passed away in the next year, you make the same income, 108,000, what kind of bracket will that person be in?
You're going to be around the 24% bracket.
Yeah, so 108 minus...
Right on the line, 22.
So your standard deduction being half, so that's in that 12 to 14,000 range. So you end up having about, wow, it just keeps cutting down real quick, doesn't it?
Right.
Yeah. So basically, you're at 94, and that puts you at the beginning of the 24% bracket when you were paying 12.
Yeah.
So in that example itself is a doubling of the taxes on the same money.
Right, and you've actually jumped 2 brackets.
Yeah.
Because you skipped right past the 22 on the way up.
Now, imagine that Roth conversions, we all think we're going to live forever, and the money's for the kids, it's for legacy. What if we say to you, hey, Roth convert for one reason, and that's for the survivor between you two will pay taxes at a lot lower rate. because most likely one of the spouses will die at some point in time. The other one will be alive and have to file single. And it's better to have some of those taxes already paid.
I've got a couple that I was looking at a couple years ago. They've got a good income. They're in the 24% bracket now. But when he passes away, then she will end up being and the tax rates go up. She'll end up being in the 33% tax bracket as a single person. So her taxes would go up a lot at that point. So we talked about, well, let's convert some of this money that's in traditional IRA to Roth IRA, so then the taxes are paid now while it's cheaper, and she'll never have to pay tax on that again.
Right. It's almost like, do you want to tax like a seed, or do you want to tax the whole tree? It's like Johnny Appleseed. I guess he went around planting trees, right? Yeah. So the seed, we could pay tax on that, which is basically what we're recommending. Pay tax today, and then let that money grow. And
then the tree is free.
The tree becomes free down the road, absolutely. Now, years and years and years, basically since 1983, when ERISA came out with the 401k concept, they sold everyone on the idea of make it tax deferred and throw it to your future, and you have less taxes at retirement. You'll be making a lot less money, and that'll work out really well tax-wise. The reality is none of us want to be in a lower tax bracket in retirement because we don't want less income. We want to be able to do things.
The second reality of that is what we've just been talking about. One spouse passes away, and now the surviving spouse is not in a lower tax bracket, even though they've got lower income. They might even be a bracket above or two brackets above where they were when they were married.
Right. So let's say there's two spouses. They're in retirement already. They're anywhere between 65 and older, and one of them gets terminally ill. We recommend that you got to think about Roth conversions. You also got to think about Roth conversions when you have medical expenses to offset it. I had a couple of situations like that where we basically did a Roth conversion based on the assisted living nursing home cost,
right,
and converted all the money over because we didn't need that money to pay the bill. We're just trying to do better financial planning.
Yeah, for the future. And that's one of the things you mentioned before about trying to stay in a tax bracket. Make sure that we're taking all the deductions into account to stay in that bracket, and let's take advantage of them. You also mentioned that the year that a spouse passes away, that's the last year that you get to file as married filing jointly. So we've had situations where a spouse has passed away during the course of the year, and the surviving spouse, one of the things we'll talk about is let's convert what we can right now this year because you get to file as married filing jointly this year. We won't have this opportunity again.
So the idea is this, no matter what your age is, think about that long-term future. If you defer everything now, you're going to pay tax on everything later. Why not diversify your income sources in your own future? Especially if you want to retire early, it'd be great to set up some tax-free income that'll come for your future. How you do it, you do the Roth option at your work, you do Roth IRAs through an advisor, through a stockbroker, or through the bank. But you do the work now, pay some tax now, and never again.
Yeah, so when you have an IRA or a Roth IRA and you've named your spouse as the primary beneficiary, your spouse, when you pass away, can take that and it will be their IRA or Roth IRA. Same rules as if it was yours, but now it's theirs. And so if you've done a conversion, that now they've got that Roth IRA that is tax-free to the future. Now, let's say the second spouse passes away and it's being passed on to the children, the next generation. Well, those folks have to put it into what's called an inherited IRA or an inherited Roth IRA, and they've got 10 years to take it out. If it's in the Roth, it's tax-free when it comes out. So no matter who it goes to, it's tax-free. So that goes back to being the best money that we can leave to kids is tax-free money.
Now, if you're a younger spouse and your other spouse passed away, let's say you're 39, 40 years old and one spouse passes away right there, and you have a choice on the Roth IRA to put it into your name or to a beneficiary Roth. Is there any case where if the spouse might want to do a beneficiary Roth?
Sure, because if you're in that age range and you might need some money that's in that Roth IRA, if you put it into a beneficiary Roth IRA, you can take it right then. That means you can take out the contribution amount and any gains, and it's all tax-free. If you take it over and make it your own, well, you can take out the contributions, but you have to wait until 59 and a half before you can take out any of the gain and get the tax benefit from it. So there are situations where we want to pay attention to, how long do you have to go? Are you going to need any of this money? And we might put that into a beneficiary account and let you take it early.
Absolutely. So what we're trying to do is this. We're trying to get money into Roth tax-free accounts, trying to get money there. How do we do that? Through contributions or conversions. The conversions should be done in the best years when you can pay the least amount of tax. So that means if you're out of work for a year, or if you started a company and had big expenses, if any reason that you don't have a lot of income for a year, it might be a great time to consider Roth converting, especially if you have some cash to pay the tax. Now, the idea of married versus single is that single pays on the same money, pays probably double the tax. So if you are sharing that money with someone that you're married to, understand the differences and why it's very important. The other thing might be considering head of household, where you have kids at home if you're single, where you have the deductions of the kids until they're 17. When they get a certain age, you no longer get those deductions. All of a sudden, your taxes go up.
All right, take advantage of your tax status now, because at some point it may change.
I had a client with 6 kids, and they weren't paying tax at all. And I'm like, hey, you're not paying tax. We got to Roth convert everything we can while you have this little period of time where you can do this.
The government is down the road standing there with its hand out. Just wait until you get there, and then they're going to take what they can in taxes.
And we're going to run it through with no taxes.
Yep.
Another quick case I'll tell you about is I had a 70, let's say she was 75 when I first met her, and she only had $20,000 in an IRA. But it was weird that the amount of the RMD that had to come out was just enough to make her Social Security taxable. It was like this happened, boom, we pay taxes on Social Security.
Domino effect.
Yeah, and so I said, well, if we Roth convert and pay tax 1 year, you pay the Social Security tax on 1 year, you never pay tax again on the Social Security, on anything, because of the way her income was set up.
How big did her eyes get?
She didn't get it. It's like, no way. There's no way, Brian. That's not going to happen. That can't work for me. I said, well, the goal was lifetime of taxes, pay the least amount. Yes, you pay more this year because we're going to convert that $20,000 all at one time. And then it's going to be tax-free as you take it out. If you don't have an RMD, you won't have to take it out unless you have a year you need the money. And she didn't even have to file taxes after that.
Did she finally get it?
Yeah, she got it. Like third or fourth meeting, we finally did it. And she hasn't been a tax client ever since, because we don't need that. And then investment client, we did the job.
Right.
And so that worked out really well. That was just a little case that worked out very well. Financial planning is very important for you, as long as we know your purpose behind why you're doing it. Knowing the purpose is the key to good financial planning. That gets rid of any of the stress that you might have in your financial decision process. So how do you get your life free of stress? Well, of course, we want you to retire, but to know that you can retire in great shape. For you to retire in great shape, all you got to do is give Acres Financial a call and sit down with one of their team of advisors to talk about your exact situation. Go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you back on Monday to schedule an in-person or a Zoom meeting. Go to acresfinancialgroup.com or give us a call at 833-946-7384 to start planning for your retirement now. Warning, when it comes to a Roth conversion, don't try this at home. We will talk about that in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
The announcer has welcomed you back, and I'm welcoming you back to the fourth quarter of Winning in Retirement. I'm Brian Akers, certified financial planner practitioner. I'm the president and founder of Acres Financial Group. But when we started Acres Financial Group, I had this certain advisor working with me. His name's Jeff Akers. So I wanted to welcome you to our show today, Jeff. Oh, it's fourth quarter. You've been here the whole time, right?
Yeah. What are you talking about?
That's true. All right. So, Jeff, you're good to go here in the fourth quarter?
Oh, yeah. It's time to finish.
All right. I promise not to foul you and put you on the foul line. We're not going to make this go long.
I thought you were the coach.
Well, it makes the show go over. We can't go over. It's like a soccer game. It's going to end when the clock ends. Yes. There's no faking injuries, no nothing.
The ref blows the whistle, boom, that's it.
All right, so this show is this: never pay taxes again. So the whole show we've been talking about Roth IRA and talking about ideas on how to convert, how to contribute, why to do all this in your situation. You need to consider, should you do a Roth IRA? Should your spouse do a Roth IRA? And we want you to think about a lot of things about your financial life. But a Roth IRA should be something you say yes this year or no this year. Make sure you know how it applies to you. All right, Jeff. So our website, AkersFinancialGroup.com. There's a radio tab. You can check out past shows. You can also hear this through our website anytime you like. Right. You ever go there, Jeff?
I do, actually. I even listen to our show.
Oh, is that just to soothe you at night to put you to sleep nicely?
Well, usually it's to listen to my own voice and say, oh, I don't like my own voice, but that's beside the point.
Yeah. Well, someone has to listen to coach ourselves about what we're saying.
That's right.
The hardest part in doing any radio show is making sure we're saying something that's important. Today's show, Never Pay Tax Again, is extremely important to us. Roth IRAs has been and will continue to be a very big piece of the advice we give with the investments we're doing, how we work with each and every client that comes in. We try to make sure the Roth IRA has been thought about and applied to each client's situation.
Right, and acted on if necessary. So far in the show, we've talked about the basic rules about Roth IRAs. You know, the idea that the money goes in after tax. When you take it out, it's tax-free. That's wonderful. How do we do a conversion? How do we get money in there? But there are some other very specific rules and things that we need to be aware of as we do it. And that's why, as Brian said, when we look at this, we figure out, is this the right thing to do for this person? And if it is, then we do it and we help you through the process. And so that's why he says, don't try this at home.
Warning.
You don't want to miss some of these rules.
Right. So let's cover a few of the rules. How do you want to do this? You want to do a rule, then I'll do a rule? We'll just play back and forth, or you just do all the rules?
No, me do all the rules. Yeah. What? I thought you were the coach, man.
I'm the coach. You can be the referee.
What are we doing? Okay. All right. So, which rule do you want to take?
I'll cover up whatever the next one.
You'll cover up whatever I miss. All right. There's a 5-year rule. So I'm going to go right into the hard ones. The 5-year rule, there's actually a few different 5-year rules. One is if you're under 59 and a half and making contributions. So you contribute to a Roth IRA and you're under 59 and a half, it needs to be in that Roth IRA for at least 5 years before you can take out the earnings and not have a tax and penalty. So you have to be, one of the exclusions or whatever, you have to be over 59 and a half for it to be a qualified distribution. The hard part is more for the folks that are over 59 and a half. And you think, I can put money into it, and the next year I can take money right back out of it. No. The gain, the increase, you have to wait 5 years before you touch that. I was reading on one website, doesn't matter if you're 105 and you make a contribution, you got to wait 5 years to take out the gain on that. Now, you can take out the contribution, what you put into it, but you cannot take out the gain. So in order to qualify to take the gain out and not pay tax, not pay penalty, it has to be in there 5 years, and you have to be 59 and a half to do that. That's right. One 5-year rule.
Right. Now, I'm thinking of 1,000 things around that, but all I'm going to say is this, is that if you're younger and you're saving for your retirement, the earlier you start, the better. You want the compounding of your money and compounding tax-free. If you're thinking, I don't want to put in a Roth IRA just in case I need it, the answer is this. If you put $6,000 in, if you're under 50, you can actually access your contribution if you need that money back. Don't recommend it, but that's there as a counter to not doing it. When you're thinking about, should I put money in a Roth? Absolutely. So depending on your purpose in life, and when it comes to retirement versus buying a house versus other things going on, we think buying a Roth early, putting money into that and saving is a great thing to do.
And when we're talking contributions, the 5 years starts with the first contribution. So it's not a new 5-year for every contribution that you put in. You'll see in a minute why that's important.
But I believe what people should do is open a Roth with at least like a couple $100, have a Roth started at a young age so that no matter what happens in life, you'll say, I started that in 2022. I'm definitely past my 5-year. Give me my growth,
Right. I can have it.
And that's very important. And what's the special situation, Jeff?
All right, so there's another 5-year rule for conversions. We talked a lot about conversions earlier. Conversions have a 5-year rule. You have to wait the 5 years to take out that gain again. And every conversion has its own 5-year rule. So if you convert in 2022, there's 5 years from that. And then if you convert again in 2023, there's 5 years from that for that portion. So you've got to keep track of all these conversions as you do them. That's why we're here. That's what we do. That's what we are for.
And that's tracked where?
It's on a tax form called the 8606 tax form.
One of the best things to do is this. Get out your old tax form. Did you put money into a Roth IRA? Did you convert? Did you do a backdoor Roth? Did you do any of these complicated Roth concepts? And then did the tax person that filled out the tax forms do an 8606? You need to check that. We found many, many mistakes done with the 8606 because there's no communication from the client to the accountant when it came to what they actually did during the year.
And with the contributions, it doesn't make any difference on that year's taxes. So all too often, I can't say every time, but all too often, that form just isn't done.
Correct. Now, we've had people go back and amend for many, many, many years and redo a whole history.
At least 5.
Yeah, I think 12,
Sometimes more.
12 was the one I'm thinking of at the moment. But the idea was to have the 8606. That's the form you got to look for on your IRS 1040.
So when you get your taxes done, just mention the number 8606 to your tax preparer.
All right, so we're doing a lot of warnings. So far, Jeff's talked about the 5-year rules. Any more 5-year rules you want to talk about?
So let's do a Roth conversion. You're under 59 and a half. If you then, I said before with contributions, you can take the contributions out in less than 5 years. With a conversion, you got to wait 5 years before you can take the contribution out. Otherwise, you will pay 10% penalty if you're under 59 and a half.
That's because they want to make sure we don't use the Roth conversion as a conduit to pulling your money out without a penalty.
Right.
But basically, you can get it there and then 5 years later pull it out without a penalty.
Right.
So it's not totally horrible, but you do pay tax. Conversions aren't tax-free. You pay tax that year.
But if you do a conversion with the plan that in 6 years I'm going to take this money out, you're really planning ahead, and most people don't get that far ahead.
But making those choices, give you choices in the future.
Give you choices. That's
all right, the other thing is, let's say you have a Roth retirement plan. The Roth retirement plan, is there a 5-year rule on that?
Yes, there are 5-year rules on that as well.
Imagine, this is the tricky one, the person's in a Roth 401k, does not have a personal Roth. Mm-hmm. The money gets transferred out of the Roth 401k when they retire to an individual Roth. Mm-hmm. Does the 5-year clock start again?
Yes.
It does. You're right.
It stinks, but yes.
Right. The only way around that rule is opening up a Roth with like a little bit of money so that receiving Roth from your Roth 401k is there already, and you don't have the 5-year rule to worry about on the taxation of the growth. Yeah,
because in that the first part of your example, that was your first Roth IRA.
Absolutely. Now, warning, we've got a couple minutes left in this show. We're going to hit with a couple more ideas. One of them is this. RMDs, required minimum distributions. On a Roth IRA, you do not have to take money out. You already paid the tax. The government's not getting any money, but they don't require you to take it out. Unless you have a Roth 401k or Roth qualified plan. If you keep your money in the company plan, you have to do an RMD.
Right, at age 72.
Why?
Well, it falls under the employer plan rules instead of the individual rules.
Okay. Well, that's just another catch and a really good reason on why everyone, when you retire, should direct roll over your Roth 401k out of there to your own personal Roth IRA. You should, if you have a Roth in your retirement account, you should open up a Roth personally so you can start the 5-year clock too.
Right. Hopefully that 5-year clock is going so that when you roll that over, you've got access to it if you were to need it.
All right, so beneficiaries, if you get the Roth and you're a kid or let's use a child receiving, someone that's maybe in their 20s, 30s, they're above 18, they get a Roth as a beneficiary. They could cash it all out at once or they can postpone up to 10 years?
Right, they've got up to 10 years to take it out if they're, what do they call that, a non-qualifying beneficiary or something?
Correct, and so that 10-year period means that you can take the money out anytime you like or at the end of 10 years, they write you a check for the whole amount, all tax-free. Many times for people, what we do is this. We do the beneficiary deferred Roth, and then we have that the beneficiary take out enough to fund their own Roth every year. They can put $6,000 if you're under 50, $7,000 if you're over 50. So we take the money out and we put it in your Roth. So instead of just having 10 years of tax-free, we then have a lifetime of tax-free to go by funding it with beneficiary money. Just these are other techniques that we're using right now.
Just taking a little bit at a time to fund that Roth IRA for yourself, and you got tax-free money for a lifetime.
So the warning is this. You need help with this. Make sure it's done right. The sad part is not all advisors know what's going on here when it comes to all these rules. There's many, many hours of training, hours of classes that we go to every year just to try to keep up with the basics of what's going on IRA and Roth law. Understanding that and applying to your situation will make your money last longer because you pay lower taxes.
Yeah, I would say it would be easier if they didn't change the rules every year, but they keep changing the rules. So.
All right. So, well, Jeff, this has been a quick show talking about never paying tax again. Roth is one of your favorite subjects?
Never paying tax again is an all-time favorite. That's why it went so fast.
And the final tease is this, is that Roth's not the only way to get tax-free income. Life insurance is another show we'll do in the future.
You gave it away.
Oh, it's in the future, though, not today. We can't explain everything. And we did not cover everything today about Roth IRA. What you need to do is give us a call and talk to one of our team of advisors about your exact situation, about your retirement and your retirement plan. We want you to be winning in retirement. So go ahead and check us out on our website at acresfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you on Monday to schedule a free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or call 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.